In an earlier discussion, we spoke about how budgeting can help with saving, and saving regularly is important. In this module, we will discuss investing the money you have saved. Saving means putting some money aside on a regular basis to meet future expenses. This should ideally be part of your monthly budget. Your savings can be used for emergencies or for unexpected expenses. It could also be used to pay for your children's schooling, or perhaps as a down payment for a piece of land or a new home. If you save regularly, the amount of money you save adds up over time. However, it may not earn a return. Return here refers to the financial benefit or extra money you receive from investing your money. The return can be in the form of interest, dividends, or profits. We will briefly explain this concept later in our module. Investing is taking savings a step further. It is a way to make your money grow over time. Investing your money is one way you can use your current savings to earn more money. It is important to remember that you must have a long-term goal for investing. This means waiting for at least 1 year or longer before using the money you have invested. As we will see later, the longer you wait, the more your money will grow. In order to understand investments, we need to know some basic concepts such as interest rates and compounding. If you have a bank account or if you have ever taken out a loan, then you may already be familiar with the idea of an interest rate. Interest is the amount charged for the use of money. More generally, it is the extra money you pay to a lender for an amount that you borrow. A lender is a person or a company that lends you money that you have to pay back later. Interest is also the amount of money you receive when you put money in a financial institution, such as a bank. If you have a savings account with a bank or a post office, you will typically receive interest on the money you deposit there. A related term is the interest rate, which is the amount charged on the percentage of money lent. You can think of an interest rate as a fee charged by the lender for giving you an amount of money you need. The interest rate is usually, but not always, stated on a yearly basis. For example, a 5% interest rate on savings account means that if you deposit 100 riyals in a bank, you will earn 5 riyals interest on it after 1 year. In other words, after 1 year, you will have 105 riyals in your savings account. Let us take an example of a loan taken from a bank. If you took out a loan for 1,000 riyals with a 5% yearly interest rate, then you will pay 50 riyals interest by the end of the year. It means you will have to pay the 1,000 riyals back in addition to the 50 riyals interest charged. That is a total of 1,050 riyals. Now, let us turn to the idea of compounding, which is an important concept in understanding investing. Compounding is an important way in which money that someone invested grows over time. To understand this further, let us look at an example. Imagine Ahmed invests 1,000 riyals today in a bank that offers an interest rate of 10% per year. After 1 year, Ahmed can expect to earn an interest of 100 riyals on his 1,000 riyals deposit. In total, he will have 1,100 Qatari riyals at the end of the year. Assuming Ahmed does not withdraw any of this money, he can reinvest 1,100 riyals the following year. Now, Ahmed has 1,100 riyals in his bank account. If he does not withdraw this amount for another year, and keeps it in the fixed deposit account, the interest he will earn at the end of the second year will be 110 Qatari riyals. By the end of the second year, his investment will grow to 1,210 riyals. 10% of 1,100 riyals is 110 riyals. In 2 years, his investment of 1,000 riyals grew to a sum of 1,210 riyals. Because Ahmed did not withdraw the 100 riyals of interest earned in the first year, it was reinvested in the second year. Hence, in the second year, he was able to earn an interest of 110 riyals, which is 10 riyals more than the interest he earned at the end of the first year. This increase in interest over time is the idea of compounding in action. It will continue as long as Ahmed keeps earning an interest and does not withdraw his money from the fixed deposit account. Let us look at another example of how compounding works over time. Ideally, Ahmed should be setting aside an amount of money regularly. For example, let us say he sets aside 1,000 riyals each year. This is called the invested amount. Let us see what happens to his investment over a period of 10 years. We continue to assume that he can earn an interest rate of 10% a year and that he does not withdraw any amount in these 10 years. Take a look at this graph. If we focus only on the amount he sets aside each year, then after 10 years, he would have kept aside 10,000 riyals as the invested amount. However, the total value of his investment after 10 years has grown to 17,531 riyals. How did this happen? He was able to gain additional money on his bank deposits because of the compounding effect of reinvesting his interest earnings each year. The main lesson here is that by reinvesting the interest each year and not withdrawing any amount, your money increases over time. This is the key idea of compounding. Another important lesson from compounding is that you should start investing early. Let us take a simple example in which there is a one-time investment. Imagine two friends who are of the same age. Ahmed starts investing at the age of 30 by putting aside 1,000 riyals that is expected to earn 10% each year. His friend Ramesh starts investing at the age of 35 and puts aside 1,000 riyals as well. What happens when both friends reach the age of 50? Examine the following graph. When they both reach the age of 50, Ahmed's investment is 6,727 riyals, while Ramesh's investment is valued at only 4,177 riyals, which is lower by 2,550 riyals. Because Ahmed gave his investment more time to grow by investing earlier, he earned a total of 5,727 riyals in interest, while Ramesh earned only 3,177 riyals. When you invest, compounding will increase the growth of your money. However, you must not use or withdraw the invested amount and the interest earned. Otherwise, the effect of compounding will be weaker. To summarize, investing requires not only that you set money aside regularly, but that you find ways to make your money grow by earning a return. You must aim to start investing early and be disciplined not to take out or spend your invested money. You should not take out the invested money before reaching your goal. Any form of investment requires that you set money aside for a period of time, which can range from a few months to several years. You must resist the temptation of spending this money, otherwise the returns on your investment will be lower or even lost. There are 3 important points to consider when you decide where to invest, the return on investment, the risks involved, and the steps required to make the investment. The first point is the return on investment. This is also referred to as the interest rate, dividends, or profits that can be earned. It is natural to think that a higher return on investment is the most important thing while investing your money. However, we must consider the return along with the risks involved, which is our second point. Risk is the possible loss of some or all of your money on an investment. You need to find out how big the risks are from a type of investment before deciding to invest. The general rule is that investments that offer high return usually have higher risks as well. You need to decide if you want to take the high risk option in exchange for higher returns. For example, a savings account is considered low risk. It is usually a safe investment and you are not likely to lose your money. However, most savings accounts offer a low return. In other words, the interest rate on this account offered is small. Nonetheless, this can vary from country to country. On the other hand, investing in the stock market could earn you a higher return than keeping money in a savings account, but it comes with the possible risk that the stock price could fall, which might result in you losing money. The final factor you must consider before investing your money are the procedures of making and managing your investment. Opening a bank account and depositing money is simple. Buying a piece of property is a more complicated process, which may require you visiting your home country or getting assistance from a relative back home. Similarly, purchasing an apartment to rent out requires dealing with the tenants, which can be difficult if you are not in your home country. The type of investments you decide to go with will depend on your willingness to bear risks and to deal with the various issues that could arise with each type of investment. There are a variety of ways to invest your money. Some ways will earn you a low return, while investing in other ways can earn you a high return. Some common ways you can invest your money are by putting your money in banks, by buying property, by investing in stock markets, or by investing in small businesses. Now let us briefly talk about each form of investment. Most of you would be familiar with the idea of depositing money at a bank or a post office in your home country. The most common type of deposit is a savings account that you can open for a minimum amount and earn interest. Another type of bank deposit is where you open a fixed deposit account. In this account, you commit to keeping money for a specific period of time, for example 6 months or 1 year. This bank deposit usually earns you higher interest rate than a savings account. Property can be a piece of land, house, or an apartment. You can buy land with the hope that its value will rise in the future. You can also invest in a home or an apartment in order to rent it out and perhaps also sell it when it reaches a higher value in the future. A stock market is a market where you can buy and sell small shares of an existing company. Stocks allow you to be a part owner of an existing business. With stocks, you may receive a return in the form of dividends, which are the company's profits. The company distributes these profits to those who own the company's stocks. However, not all companies give out dividends. In addition, you can benefit from the increase in the value of a stock. Stocks usually offer higher returns than bank deposits. However, there is a higher risk in this method of investment, as you could lose some or all of your invested money if the company does poorly or goes out of business. One way of reducing the risk is to purchase mutual funds from a company that pools your money together with other people. to buy stocks in many companies. Not all companies may fare poorly at the same time, so your chance of losing money will be reduced. If you are interested in stock, seek the advice of experienced individuals or financial advisors. A business is where one trades in goods or services in exchange for money. Typically, the aim is to make profits, which is a type of return on investment. Profits refer to the sales revenue you receive that is greater than the cost to run the business. You can invest a lump sum amount of money to start or expand an existing business. However, before you start a business, you need to do a careful study to make sure your business attracts people to buy the goods or services offered so you can earn profit. You must have heard the phrase, "Do not keep all your eggs in one basket." The same idea applies to investing as well. That is, you should not put all your money into one type of investment only. For example, keeping your investments in a savings account might reduce the risk of losing your money, but it will provide a low return. On the other hand, investing entirely in the stock markets might provide high returns, but also raise the risks of losing some or all of your money. The point here is to have a mix of different investments so you do not lose too much from the impact of a fall in the value in any type of investment. A simple rule is that the younger we are, the higher the share of money we can consider putting in riskier investments, such as the stock market. This is because we will be better able to manage any loss in the value of those investments. We are still likely to have jobs and receive an income to support ourselves and our families if some investments do poorly, and we can continue to save money over time. However, as we get closer towards retirement age, it is best to have more investments that are less risky, such as bank deposits. In conclusion, investment is an important way of making our money work for us. We have provided a simple introduction to the concept of investing. Do seek the advice of people who have the experience of making various investments before deciding where to invest your money.